Hi there, everybody. Hi there, everybody. Thank you so much for joining us. Again, my name is Anthony Wright. I'm the Executive Director of Families USA, the national consumer advocacy group on healthcare issues. And in that role, we have been tracking healthcare cost projections, and we are here today to give an update for those who buy individual insurance in the marketplaces set up under the Affordable Care Act. Specifically, we'll be providing a mid-year look at what premiums are shaping up to be in 2027 based on what the health plans are now submitting to their state regulators and to discuss what's driving another round of steep increases. I'm happy to be joined today by Families USA Senior Advisor for Market and Insurance Regulation, Jennifer Sullivan, who will dive into the deeper details about the actions this administration has taken to undermine the ACA market. We're also joined by Susan Allman, a marketplace enrollee, who will share her personal experience of struggling to afford healthcare coverage in an uncertain market. And we're also really pleased to be joined by two leading state health advocates in places that are seeing particularly big jumps. Whitney Griggs, the Director of Health Policy at Georgians for a Healthy Future, where Georgia has a proposed rate increase of, on average, of nearly 21%. And finally, we'll hear from Emily Bryce, Co-Executive Director of the Northwest Health Law Advocates in Washington, which has the second highest proposed rate thus far at 22.4%. So let's get started. These double-digit rate hikes are the headline. After years of single-digit percentage rate increases since 2019, the rate filings to date show a second year of double-digit percentage rate increases, on average around 15%, mostly the result of deliberate decisions by this president and Congress. The bef- let's I want to get into the details of these proposed rate increases, but let's take a step back to remind us of our recent experience. The ACA created marketplaces to buy health insurance that covered health essential benefits, that had no denials for pre-existing condition, and that provided affordability assistance for those under four times the poverty level. And about 5 years ago, the Congress enhanced those tax credits so that nobody buying a silver plan had to pay more than 8.5% of their income, and in many cases less on a sliding scale. This policy was wildly popular, driving enrollment from about 12 million enrolled in 2021 to a record high of over 24 million by 2025. But that success has stopped. Despite a full court press from advocates, patients, and despite a bipartisan majority in both the House and the Senate supporting these tax credits, President Trump and Congress blocked their extension. This deliberate decision to end the enhanced tax credits have made people have to pay double for premiums on average, often hundreds, if not thousands of dollars more. Such a shocking spike in premiums led many to drop affordable. Nearly 4 million people have dropped marketplace coverage this year, and a total enrollment is down about 5 million since President Trump took office, a number that is likely to grow. While millions become uninsured, millions more are becoming underinsured, dropping down to plans with sky-high deductibles, literally paying more and getting less. These losses reshape the market for everyone else. As healthier people are the first to drop coverage, insurers price plans for a smaller and sicker risk pool, pushing premiums up further for those who remain. Driver of last year's 2026 premium jump. Because again, after years of single-digit premium increases from 2019 to 2025, marketplace premiums jumped an average of 25% in 2026 alone. That's the cycle playing out again in these 2027 filings. The initial findings show another year of double-digit percent increases, so far averaging around 15%, on top of the big spikes of last year. Our review of the rate filings at state regulators show that insurers are directly attributing the increase to rising hospital and drug prices, consolidation, and yes, the continued loss of coverage and the uncertainty in the individual market. We need Congress to address both the root cost drivers of high healthcare costs and to provide affordability assistance that people need as soon as possible. While some are protected from these increases by the original ACA affordability assistance, the end of the enhanced tax credits means that many more are facing the full brunt of these premium spikes without any help. These are individuals and families that work but just simply don't get coverage on the job. They are small business owners and their workers, contractors and consultants, gardeners and gig workers, freelancers and farmers, young folks in entry-level jobs, and early retirees awaiting Medicare. After our speakers provide testimony from the patient and state advocate perspective, we'll offer some consumer advice for people who buy individual insurance facing these premiums. But before that, I want to pass it off to our own Jenny Sullivan, our senior advisor for market and insurance regulation, to detail the increases in the states and the additional policy reasons for this drop in coverage and rise in premiums. Jenny?
Great. Thank you, Anthony, and thanks, folks, for joining us this afternoon. So let's unpack more about why rates are continuing to rise for 2027. So when insurers propose their rates for a given year, they have to include a statement justifying increases of 15% or more. And these statements are available publicly. So when we start to sift through them to see what insurers are saying for 2027, two main themes emerge. The first is increased hospital and prescription drug costs, perhaps not surprisingly, and not a phenomenon unique to the marketplaces. But this is due to both increased utilization, which is related to the second theme, and higher reimbursement rates to providers. But the second thing that's really driving insurers to increase their rates is that as enrollment has declined, as Anthony mentioned, the risk profile among remaining enrollees has deteriorated. That means that insurers are expecting that those who remain enrolled will need more care, which will cost more, and so they are increasing rates for everyone to absorb those increased costs. We didn't get here by accident. The expiration of the premium tax credit enhancements, as Anthony mentioned, at the end of last year, drove premiums up dramatically for this year, and people who were healthier and expected to need less care were more likely to drop coverage, leaving behind those who truly can't afford to go without because, for example, they have a chronic condition or they're in the middle of receiving treatment for a serious diagnosis. In addition to rising premiums that priced people out of marketplace coverage, we also saw enrollment declines because of policies in H.R. 1, that's last summer's mega tax cuts bill. For example, the law made certain very low-income legally present immigrants ineligible for premium tax credits this year. And the law piles on again for next year in 2027 when it significantly restricts eligibility for premium tax credits to all but U.S. citizens and a very narrow group of legally present immigrants. These new eligibility restrictions are expected to cause hundreds of thousands of additional legally present immigrants to lose coverage over the next decade. Now, this administration had also planned to implement a series of policies through regulations finalized last year and earlier this year that would have exacerbated these dynamics by creating new barriers, making it harder for people who wanted and could afford coverage to successfully complete the enrollment process. This includes things like increasing income documentation requirements for certain people, increasing documentation requirements for people who have a life change and qualify for a special enrollment period to change plans or newly enrolled during the year, and withholding premium tax credits from people who haven't completed the process of reconciling a past year's tax credit with the IRS in time for open enrollment. Now, we know that changes like this are very effective at stopping eligible people from enrolling, particularly healthy people who might not have an immediate need for care. This administration also attempted to shorten the annual open enrollment period, which would have reduced enrollment, again, particularly among healthy enrollees, the ones that are needed to maintain a robust risk pool and keep premiums down. However, all of these provisions I've just mentioned were challenged in court and have been overturned or at least temporarily paused for the time being. But the administration is challenging these decisions, and insurers have to take all of this into account as they set rates for a very uncertain market in the year ahead. So all of this means that consumers can expect more of the same in 2027, premiums that stretch their budgets and force them to decide between a monthly premium that's out of financial reach and a lower premium plan with a skyrocketing deductible, making it difficult to actually afford care when they need it. And for 2026, fewer than half of marketplace enrollees selected a silver plan, while the share of enrollees choosing a bronze plan rose to 40%, which is a historic high. I mention this fairly wonky detail because one of the ACA's critical affordability protections is cost sharing reductions for people with income up to 250% of the federal poverty level. But these reductions are only available to people who enroll in a silver plan. So people may be foregoing these lower out-of-pocket costs right now in exchange for a lower premium when they switch from silver to bronze. But all of this is really put in better perspective by hearing from somebody who's actually living through it. So to understand these dynamics from somebody with that experience, I want to pass it over now to Susan.
Hi, thank you so much. I want to really thank y'all for having me on to tell my story, and not because I think my story is so important or unique. It's because I think that my story represents the story of the majority of people in this country right now. Um, I am a cancer survivor, and I'm also an ACA enrollee. I um, went for most of my adult life without health insurance because, as Jenny was talking about, I was one of those healthy people. So that was something that I would forego my health insurance so that I could afford to, pay my bills and stuff like that. And because of the enhanced tax credits, I actually got back on health insurance, and it was just in the nick of time. It happened the year before I was diagnosed with breast cancer. So I feel really fortunate in that respect. When I did re-enroll, my coverage was relatively it was okay. I didn't go for the silver or the gold because of my income. So I did have the bronze, and so I had that for the last couple of years. And last year was my struggle with cancer, and so because of the high cost of fighting cancer, my deductible was met, which was a $7,500 deductible. And I had a $9,000 out of pocket. And, one treatment of immunotherapy actually costs $42,000. So one treatment went ahead and covered my my deductible and my out of pocket. So last year, that was fine. I finished cancer treatment, and I was very worried about what would happen this year. My premium increased by over $300. And that's staying with a bronze plan. So, and the problem now is that there is on this bronze plan zero deductible, and a $10,500 out of pocket. So although it's very confusing, what I have learned by having to navigate this is that a zero deductible means you don't actually meet a deductible where the insurance company starts paying on the health care you need. It doesn't really kick in until you hit the $10,500 mark. So that has impacted me, and just because someone says they're a cancer survivor, that doesn't mean that the journey is over. It kind of is the beginning of its own journey. So while I don't have to do the $42,000 immunotherapy treatments anymore, I have been impacted throughout my whole body by the treatment that I did receive. And unfortunately, because of the plan that I have, I am unable to receive the treatments that I need for my own health to navigate through this recovery process. I have foregone visiting my oncologist because part of this plan, the copay that you have to pay to a specialist is more than double what you pay to see your primary care. And then, of course, to do blood work or to do testing, is I have to pay for that. So it's been a really really tough navigation this year because of these barriers to getting health care. So I've missed my appointments, and I've been unable to get the testing that I need. And I think that what's happening is a travesty, and the fact that people that are healthy or not are losing their health insurance. I understand just how precarious that position can be. No one thinks that they're going to get diagnosed with a life threatening illness, but it can happen, and that's really scary. And I think that uh, when Anthony said paying more and getting less, I actually wrote it down because that is exactly what's happening. You know, I, this plan is almost back in the day we used to call these insurance policies catastrophic insurance because you really only had it to for a cat, but to have this as your like insurance to try to navigate through a health experience. It is a matter of choosing paying your bills or getting groceries over having health. And some of my struggles, from chemotherapy, I can't get help for right now. So I'm sure that this is a story that is repeated by many, many people in this country. So anyway, that's my story, and I'll now turn it over to Whitney. Thank y'all for having me.
Thank you, Susan. Hi, I'm Whitney Griggs. I'm the Director of Health Policy with Georgians for a Healthy Future. Georgians for a Healthy Future is a nonprofit that works to expand access to affordable health coverage and care for Georgia consumers. Today, I'm going to walk you through what the proposed rates look like in Georgia, although Anthony gave a bit of a preview of what we're seeing, what our state has already been through since the expiration of the enhanced premium tax credits and looming HR 1 changes, and what Georgia consumers can do this fall to ensure that they are able to stay enrolled in their marketplace coverage. I'll start with what we're seeing in the proposed rate increases for Georgia because it's really quite staggering. Insurers have filed their proposed 2027 rate increases for Georgia Access, which is our state-based marketplace, which began operation in 2024. And every consumer currently enrolled in Georgia Access is the insurer for every consumer enrolled in Georgia Access is asking for a double-digit increase in premiums. The lowest request is about a 12% increase, and the highest is over 54% increase in premiums. Across the whole market, as Anthony said, it averages out to about 21%. So for a Georgia family paying full price for a plan, that's roughly $1,900 more next year just to have the same health coverage. These proposed increases will occur on top of the already staggering premium increases Georgia saw in 2026. Unfortunately, the expiration of the enhanced premium tax credits and the changes under HR 1 have caused Georgia to become a victim of its own success. Georgia built one of the largest marketplaces in the country through Georgia Access. In January of last year, more than 1.5 million Georgians were covered through Georgia Access. Then the enhanced premium tax credits expired, and for a lot of families, their monthly insurance bill doubled or even worse. And by this April, enrollment had fallen to about 950,000 Georgians. That's more than 500,000 Georgians gone from Georgia Access, and a 37% drop in Georgia Access enrollment. This means that people are giving up their plans. This means that they're no longer able to get the care that they were getting. And this means that Georgia's safety net provider infrastructure is having to bear a lot more burden from these newly uninsured folks. One of the reasons that Georgia is seeing such a huge impact is because we had so many folks enrolled in Georgia Access, and now we're seeing the younger, healthier folks be the first to drop coverage. So our risk pools are higher, leading to that, or our risk pools are older and sicker, leading to that cyclical issue of causing the plans to go up, more young and healthy folks drop off. And that's really what you're seeing in the second year of these really high proposed rate increases. These rate increases, as Jennifer mentioned, aren't happening in a vacuum. There's several other changes hitting Georgia's coverage landscape at the same time, including the changes under HR 1, which will make it more expensive and administratively burdensome for the state to operate its Medicaid program. We've already seen an insurer, Cigna, pull out of our market, and we're seeing other changes from HR 1, such as changes to immigrants that are allowed to enroll in coverage. These are going to continue to squeeze our rural health providers, especially Georgia's struggling rural hospitals. And we know that when a rural hospital closes, the impacts go far beyond just the loss of the hospital itself, but really impact the community. And because Georgia has not expanded Medicaid, we have a large number of folks who would be eligible for Medicaid that are on Georgia Access, and they're also significantly impacted by these increased premiums. And so what can consumers do to prepare for open enrollment 2026? There's three main things that we're telling consumers. One, be aware of changes to open enrollment deadlines, whether that's specific to Georgia or to states that are federally facilitated marketplace. Georgia's open enrollment this year will go from November 1st, 2026 to January 15th, 2027. This year especially, you'll need to go to Georgia Access and make sure that you have all of your paperwork, all of your documentation, and make sure that you're looking at plans. Don't automatically select the least expensive monthly premium, because there's some really significant trade-offs there in terms of deductibles. And also, you don't need to figure this out alone. There are certified application counselors like GHF has. There are licensed insurance agents. There's lots of help available, and you can go to georgiaaccess.gov to navigate this process, but don't get this, don't let the high premiums turn you off from coverage, because there may be options that are still a good fit for your budget. And with that, I will hand it over to Emily.
Thank you so much, Whitney. Hi, everyone. Good afternoon. I'm Emily Bryce, Co-Executive Director of Northwest Health Law Advocates, a nonprofit that has worked for over 25 years to ensure access to healthcare for all Washingtonians. Here in Washington State, way over on the other side of the country, we built our own marketplace that has successfully operated with bipartisan support for over a decade. 1 in 4 Washingtonians use our marketplace, Washington Health Plan Finder, to get connected to health coverage. Folks who use Health Plan Finder today have a great experience in many ways. They can easily compare health plans with standard benefits. They can access state premium assistance and get help from a local navigator. And we're proud of all of that state progress. But unfortunately, the price tag for those marketplace health plans keep going up due to the Trump administration and his allies in Congress, who chose to give tax cuts to billionaires instead of helping people afford their health care. I want to thank Susan and Whitney for sharing their perspectives, which resonate so deeply with all of us, and really is striking how similar the experiences are no matter where you are in the country. But I'll give a little picture of what it looks like in my state, Washington. So here we are entering the 5th straight year of nearly double-digit premium increases. For 2027, Washington has the highest proposed premium increase in the nation, with insurance companies proposing to increase premiums by over 22% on average. And if those rates are approved by our insurance commissioner, they will hit Washingtonians whose premiums have already nearly tripled over the last decade. Typically, we are proud to be #1 in the country, but not this time. So in real dollars, the average silver plan for next year in 2027, if these proposed rate increases go through, will cost $970 a month. How is any family supposed to afford that? The folks that I'm talking to every day are doing survival math. forced to choose between affording their health coverage and other basic needs like food and rent. Even before this latest premium increase, Washingtonians were already struggling with costs. 2 in 3 Washingtonians we surveyed last year had to skip healthcare they needed due to high costs. And now that's only going to get worse instead of better. After this federal administration let the enhanced premium tax credits expire and then passed the harmful H.R. 1 bill, marketplace customers were forced to drop coverage here in Washington at nearly twice the rate of recent years during our most recent 2026 open enrollment. We're still reviewing the very latest numbers because this is changing every day, but it looks like about 55,000 Washingtonians have already had to drop their marketplace coverage so far this year. People don't make that choice lightly. We all know that going without insurance can be disastrous if you get sick or injured. So I do encourage people to shop around, get free help from a navigator to find the best plan, and stick with coverage to the extent that they can. But these are tough choices that more and more Washingtonians are facing as this federal administration has failed to keep a lid on rising healthcare costs. And we know that even more Washingtonians are facing challenges and will lose coverage later this year as the H.R. 1 cuts ramp up to cruelly target immigrant communities and lower income folks who rely on Medicaid. We need something different. We need leaders who will help people with their health costs now while also doing the hard, longer term work to reform our health system so that big insurance companies, hospitals, and drug companies stop these escalating prices. And with that, I'll turn it over to Anthony to close us out. Thanks.
Thank you so much, Emily, Susan, Whitney, and Jenny, and everybody for attending today. I There's other things that we could talk about. We could talk about both individual advice to patients having to deal with these issues. We can talk about the policy decisions that led to these double-digit percentage increases. We could talk about the specifics in the states like Nebraska, Georgia, Washington State. And so happy to get questions from the reporters here. Feel free to either just come off mute or put something in a chat. Who wants to start? Tammy, you raised your hand. Go ahead.
Hi, thank you for holding this call. My question is mainly for Whitney and Emily. Typically, how much do your states reduce the proposed increases? I don't know if Georgia, now that it has its own marketplace, is doing this, but what do you think we'll actually see in terms of proposed rate increases after the process is done?
Sorry, Emily, I saw you raise your hand, but I'll just jump in. So Georgia does not have any sort of premium assistance program, so there's no state support to help reduce premiums, like I know some states like New Mexico have. Georgia also has a pretty Georgia's insurance commissioner does not have a lot of authority over rate review, so there's not a lot that the state can do to push back on these rates. So any changes that we would see in between these proposed rates and the final rates would likely come from either some bigger change in the landscape that's caused insurers to lower the premiums themselves, or some other internal pieces that have caused the insurers to decide to lower their premiums. But as a state, Georgia does not have many tools in its toolbox to bring those rates down.
Thanks. And I'll add on to what Whitney shared. So in Washington State, we do have an active insurance commissioner and what's called an effective rate review process, which means that the insurance commissioner has the opportunity to look at those proposed rates and really scrub them to make sure that they are warranted. Unfortunately, what we've seen in the last several years, and I do anticipate again this year, is that the insurance commissioner's authority can only go so far, similar to what Whitney said, because if the rates are what's called actuarially justified, which means that the insurer is looking at the risks in the market, the changing risks that we talked about on this call, and the rising pharmaceutical and medical trend that is driving those rate increases ever upward. The insurance commissioner's hands are tied in some ways, and she will need to approve the rates largely as the insurers request them. For many years, advocates have asked important questions like why isn't the insurance commissioner allowed to look at the surplus that we see accumulating from insurers? Some insurers, for example, in Washington, are sitting on billions of dollars that they've accumulated over time. So I think important questions like that are warranted, important questions about why the state and at a national level we are allowing that medical and pharmaceutical trend to continue unchecked. But currently our tools are limited, as Whitney shared. In Washington, we do also have a state premium assistance program we're very proud of called Cascade Care Savings, but at most that has been stretched to be $250 a month. And we have seen that it just is not enough, particularly for people who are losing premium tax credits at a federal level, and particularly given the fact that states are going through their own budget challenges right now that are escalated by the billions of dollars that HR 1 is taking directly from states on healthcare. We anticipate that those state funds are going to be very stretched.
And may I just ask a quick follow-up to Emily? You had said that over the last 5 years, there were double-digit rate increases. Did the commissioner lower the rates at all or by a small amount, or were they essentially go through as proposed?
We saw them be lower typically by maybe a couple percentage points. It depends on the particular scenario, but really they have kept pace at a high level with the proposed rates in the last couple of years.
Thank you.
Yeah. Yeah, I think it's a great question, which is, and just a proviso that as we start getting these uh, filings from state regulators, that these are preliminary rates. There is many states have some sort of review process, and some of that does result in some adjustments, in both directions, to be fair. So uh, this is an important early indicator of what the rates will look like in 2027. And then the other indicator, as was mentioned in Washington State, is that there is about 10-ish states that have some form of additional affordability assistance that they add into the mix. Um, One state, New Mexico, is the one state that has fully sort of backfilled the entirety of the loss of the enhanced tax credits at the moment. And not shockingly, that's the only state that has not seen a drop in enrollment. There's a clear correlation here. This is not rocket science of the relationship between these tax credits and the coverage losses. Uh, but it's unclear the sustainability of how if New Mexico can continue that um, into the future, and the other states that are doing it are working within the limits of what states can do. California may have, I think, the biggest dollar amount in terms of an affordability assistance fund of around 300 million, but the loss of the enhanced tax credits to the state to Californians who that got those benefits was in the realm of about 1.8 billion. So like literally the 300 million is literally like a seventh of what was lost to people's ability to afford health premiums. So that gives you a sense of the scale of what we're talking about here, where when states are doing things, they can maybe shave something in terms of challenging the insurers by a couple of percentage points. Maybe they could provide some additional assistance, but it's hard in the context of the broader loss of significant help for people to afford coverage, and that's what people are dealing with. And then they're getting the double whammy of these increases rates without the help of the additional assistance of the enhanced tax credits. Are there other questions that people want to raise? And then I'll get to Catherine's and Sunita, and then we'll do Sunita, and then we'll go to the Catherine's in the chat. Sunita, go
Yeah,
ahead.
thank you. I wanted to ask, how does private equity figure in here, buying up practices, etc.?
I'm happy to start, but I would love my state advocates or others or anybody else to weigh in, which is, I think that is a driver. Like again, as Jenny mentioned at the beginning, right? Like the two major when the insurers are reporting why are these increases happening, um, One of them is about the smaller and sicker risk pool and the impacts of having of the drop coverage, but one of it is the ever increasing cost of base cost of healthcare, and a lot of that is due to things like consolidation, and whether it's the mergers between between health providers or the entry of private equity into a space to uh, own a field, whether geographically or use that leverage point to jack up rates. Uh, that is a pernicious impact of the influence of private equity, where they are using the fact that there are market failures in healthcare, places where people can leverage market and monopoly power to charge ever increasing rates, and that is being reflected in our rates in specific ways. And that happens with whether it's with big things like hospitals or with relatively more specific. In more specific areas, whether it's ambulance services, anesthesiologists, or anything like that. But I'll open up to see if if my colleagues have any examples on the ground, since there have been some startling ones from Massachusetts to Pennsylvania to other states.
I think that you covered it well, Anthony, and I'll just say from a state perspective, it can be difficult to know and track the activity that Anthony mentioned that is impacting healthcare costs overall. But some states have limited tools to be able to view that consolidation activity. So in Washington, for example, we have done some analysis that shows in significant increase in private equity activity in the healthcare space, but the state, in order to do that activity, had to comb through Deal Book, which is basically a trade tool to understand what's happening in the space. The state didn't even have that information available to them. So states like Washington have been looking at and trying to pass policies that would give the state more opportunity to look into that private equity activity and understand the consolidation trends that are driving healthcare costs ever upward. Some states are further along, like California and Massachusetts, and others states are still working on that journey, like Washington.
Yeah, I will just echo that. I think Anthony and Emily hit the nail on the head. Georgia does not have a lot of tools to look into private equity to really scrutinize business deals like that. But we are beginning to look at the impacts that consolidation have, especially in more rural parts of the state where where there's already fewer providers. So, putting that in the bucket of increasing provider cost certainly has an impact, but we can't say specifically what's tied to private equity and what's not.
Thank you.
Amy, go ahead. I know you were unmuted for a bit here.
Oh, hi. Hi. Thank you so much for the for this webinar. And I actually had like 1,000 questions. But I'm honestly like three. But I wanted to, a couple of them are more like clarifying. And the first was for Susan. And Susan, thank you so much for telling your story. I wasn't clear if you had lost access to your tax credits or if this was fully because of the premium increases. I just wanted to know exactly why you saw such an increase.
Thank you for the question, Amy. I have not lost access to my tax credits, but the increase of the premium, of course, even with your tax credits, still cost more per month. I don't know. Is that what you're asking?
Absolutely, absolutely. Thank you so much. So even though you kept your tax credits, you still saw that $300 increase just based on that.
Right. From 1 year of from I think the rate was like 800 and something, and now it's over 1,100 a month for the.
Okay. Thank you so much.
Thanks.
Yeah. And I'll just say that again, just in terms of the loss of the tax credits, there's people who are over 400% of the poverty level, which is around um like 63,000 for an individual, 130,000, 132,000 for a family of four. There's people who are just over that amount who lost all help in the exchanges, but in the marketplaces because of the expiration of the enhanced tax credit. But a lot of people who are under that threshold also lost help as well. That the ACA had one level of support, and then the enhanced tax credits um,
True, true. Okay. Right. Because
improved
it was
that.
like 8.5 and then six, the, okay.
Yeah, so
Yeah.
people who are paying like, there are some people who are paying 2% who are paying 0%, who are paying 2%. Some people who are paying yeah, 3% are now paying 5 or 6 or 7%, etc. So I just
Right.
so that but and then of course there's people who are cut off entirely after who are above that 400% threshold who may have been paying who under the enhanced tax credits were limited to 8% of their income and now are paying 10, 20, 30% of their income on coverage.
Gotcha. And thank you so much for that reminder because I tend to get like really stuck in the like no credits
Yeah.
versus, you know, versus
And Amy, I'm
like,
happy to go back to you in a second, but I do want to answer on
absolutely.
another question. And I want to answer Catherine and want to offer anybody here to answer the questions about just practical advice for people when they're weighing their options. And Emily, why don't you start? Go ahead, since you raised your hand.
Thanks. Well, Whitney covered this very well, so I think Whitney will reiterate some pieces of that, I hope, in a moment. But just a couple of things that we encourage folks to do. One, make sure your contact information is up to date with your local marketplace, or your Medicaid agency, whoever is sending you your health coverage notices, because there's going to be a lot of changes coming up, and it's going to be really important that you receive that and make sure that if you're getting your notices electronically, it's not going to spam. You've got your most recent address in there. Two, really watch that mail this fall, because in addition to the premium increases, which will lead you to maybe want to shop around, look for the best option for you, there are also lots of changes to eligibility that are happening this fall, and particularly some immigrant communities, people who are enrolled in Medicaid need to watch for changes to eligibility or changes to the way that people can retain coverage. So encourage people to just really keep an eye on their mail. If you see that health insurance notice, don't put it aside for later, as we all do it. Don't put it on the kitchen counter and look at it later, look at it now. And then the third thing I'll just encourage people to do is really meet with a navigator or broker and licensed broker. Whitney mentioned the many free options that are available to people to connect and talk about their health insurance. You can find a list of trained navigators and certified brokers on your state, local uh, insurance website, like, for example, in Washington Health Plan Finder or healthcare.gov. And you're going to want to talk to people earlier than you usually do. So don't wait until December. Don't wait until the day before open enrollment closes. Get in there and start talking to people in the fall this year.
I wanted to chime in with something else that people should pay attention to that's actually a middle of the year thing. We are in August right now, and as people who are currently enrolled in marketplace coverage are thinking about their lives and how they might have changed from when they signed up at the end of last year, it is really, really important, more important than ever before, to go back to the marketplace and make sure that your income is up to date and that then adjusts the amount of premium assistance that you're getting. I say that because the HR1 put a new policy in place that gets rid of what had previously existed caps on what people have to pay back if they get more help through the premium tax credit than they're ultimately eligible to receive when they reconcile taxes. And the best way to avoid a surprise next year on tax day is to make sure that every month of this year your income is up to date on the marketplace, which is frustrating. Nobody wants to do that. Nobody wants to spend time updating their income and going through these administrative hurdles, but it's really important because people will have to pay back every penny next year when they file taxes if they've received more than they were eligible for. So,
And I'll just echo everything they said. Do it early. Make sure you have everything in line, but also don't panic. Just because the enhanced premium tax credits are gone, there's still financial help available to many, many folks. And just if you see a number you don't like, you may be able to shop around, even if that means getting a different plan. And again, as Anthony mentioned, these are proposed rate changes. buying health insurance is not fun. I don't want to do any of this stuff. So I get for consumers, this is just another administrative pain to deal with. But deep breath, start early, and make sure that you shop around.
Yeah.
Thanks.
I'll
That's
agree.
super helpful.
I'll agree with my colleagues and just with regard to get help, get make sure you're fully on notices, information like that. I would also say that actually in your we're talking about averages and that has broad impacts, but averages mask a lot of differences between plans, between tiers, and so it's really important to shop and compare. And it's really important to recognize, especially that if you're on the marketplace now, the best deal last year is not necessarily the best value this year. That just the way it works is that um, again, between these averages, some plans might have spiked a lot, some may have had a very modest increase, and then that also has an impact on like what the level of tax credit or subsidy based on the second lowest cost tier plan. Like so, just it really is important to take a close look at that and look at your options and understand the trade-offs between premium and cost sharing, as Susan was talking about. That a cheaper premium it may be that your situation is that you just need a cheaper premium in order to make rent and everything else, and then but also recognize that that comes with a much higher cost sharing, like Susan is experiencing when she's dealing with her medical situation. So just those are some pieces, and just take it as Whitney said, take advantage of the assistance that's still available. Um, uh, the ACA, the base ACA tax credits did not go away, and folks should take advantage of that, and then just be an advocate for their expansion and continued extension. That's the work that we all need to do. So to take advantage of what's available and fight like hell for their expansion and in and extension. Amy, go ahead. Oh, I'm sorry, Susan, you wanted to say something.
Well,
Please,
talking
from your
about
experience, absolutely.
well, when I hear practical things to think about, as you navigate through the changes and stuff, I mean, just from the perspective of a person on marketplace, I would also add to, really make sure that your healthcare providers go with you because, a lot of people might be looking at trying to navigate this through monetary means, but if you're a person who's been impacted with health issues, it's very vital that you make sure that your providers are going to go with you too when you change insurance. I just wanted to add that.
No,
That's super
absolutely.
helpful. Yeah, thank you very much for sharing that.
Yeah. Susan, did you have a question? If not, then okay. So then, Amy, go ahead.
Oh, okay. Hi again. Thanks. My question was about the Emily had mentioned that I believe Emily or Jennifer had mentioned that some plans have cited the ACA exchange rule as a reason they're increasing premiums. Now it's paused. Are you all going to be watching to see if those plans are going to reverse? Or, I mean, is that something that you're watching for? Is that another reason that the premiums could change? I mean, I know other things are paused as well, so
Yeah, I mean, we will certainly
both ways, but I'm curious.
we will certainly keep an eye on that. The litigation is dynamic, and the implications for 2027 and beyond certainly flow from that. So we will be keeping an eye on how state regulators are responding to these requests and the changes that they make. But I think what we see right now, largely, it reflects some uncertainty about what might happen with these policies, but these policies haven't been implemented yet. If they are allowed to go forward, if some iteration of them gets through the courts and is implemented, that could come as soon as later this year, early next year, we're going to see more attrition from the marketplaces. We're going to really start to feel the impact, and issuers are going to respond to that again as they look to 2028. So it's very much an ongoing conversation. But Emily, I don't know if there was more you wanted to add there, or Anthony.
I think that's exactly right. Any other questions, just in the last couple of minutes here? I really appreciate folks' engagement on this. This is such a important topic. Uh, we've been talking about affordability with regard to eggs and gas and other things, and but the cost of healthcare, literally a doubling of premiums last year, double-digit premium increases last year, and now this year. That is just such a major drain on people's financial security, and so it just is such an important topic to discuss. Any other questions? Amy, is that another hand or okay?
Oh, wait. Actually,
Yes, go for
yes,
it.
it is. I'm back with more hands. Um, honestly, I was on a call. I missed the first part of this webinar, so I I don't know if you talked about, efforts to get to reinstate the subsidies, how that's going, what's the plan? Are you engaged with other lobby, or lobby, et cetera,
I mean, we continue to call for the extension of the tax credits, that there's no reason why Congress can't retroactively uh, um, uh, put in place the tax credit for 2026. Um, and that would allow for an adjustment to the rates that are being thought about for 2027, as this goes through a regulatory process. Uh,
Mhm.
I'm obviously we know that we have a majority in both the House and the Senate for this. We actually had a bipartisan discharge petition that included both all of the Democrats, but also 17 Republican members of vote for extending these tax credits for several years. We had a majority in the Senate, but the congressional leadership blocked, and President Trump blocked that extension. And so so the question is, does this come up in budget negotiations either this year, or if Congress changes its makeup and its leadership in the previous years, does that then create a different and new opportunity to revisit the extension of these tax credits? That's a really important advocacy point for us. And it's important to just to recognize where various senators, where various representatives are, whether they be in Georgia, Nebraska, Washington, or elsewhere, where they are with regard to this specific issue. So we're not giving up, but we also recognize that, again, this was blocked by the current congressional leadership, but there's the possibility that there will be different congressional leadership and different makeup of Congress in a new Congress when next year.
Great. Thank you.
Sunita.
Yeah, I wanted to ask a question, and it may be sound slightly off topic, but it's not. As public charge rolls out on September 18th, we've already seen a drop off of people insuring. Is that smaller pool also going to drive up the costs of healthcare?
Thank you so much for asking that question. Jenny, I know you were going to say, you said a little bit about this. I don't know if you want to say anything. And Emily, I know you were nodding.
I mean, we know that the public charge rule historically, when it reared itself last time, caused tremendous chill, both among people who might legitimately have been affected by it, and lots of people who weren't, and lots of their citizen children who then didn't get the coverage and the care that they needed because they were afraid of these rules, which is exactly, I would wager, the intent. But uh, anytime you're seeing people peeling off from the marketplace who are healthy and should be there, that has an impact on the rates, that has an impact on the health of the overall risk pool, and that affects everybody. It's a single risk pool for a reason. We pool risk to keep rates down for everybody, and when healthy people decide for whatever reason that that's not a place for them, that impacts everyone.
Thank you.
Yeah, I mean, I would add that to both the sort of explicit, HR 1 does have explicit provisions that drop uh, legally residing immigrants from coverage, and also has And then there's these other policies that have a chilling effect that would lead others to drop off as well. And that again leads to the smaller and sicker risk pool, the higher premiums for everybody. All right, with that, again, just want to say thanks for everybody and of these consecutive cumulative double-digit premium spikes that are not incidental. They are the result of deliberate policy decisions being made by President Trump and Congress, and that we are continuing the spotlight. Families USA has a real-time premium tracker on our website. That as we get updated numbers from the states, we're putting that up on the website in real time. That link is in the chat, and. So I just want to thank everybody, and everybody on the call today is available for continued follow-up as you do this reporting now, today, and into the future. Erin, did you have any last housekeeping issues? Otherwise, thank you very much.
You covered it. Thank you.